DNA sequencing company Illumina posting better than expected results, also announcing a plan to reduce run rate expenses by $100 million annually. The company has found itself right in the crosshairs of activist investor Carl Icahn and a proxy battle. Illumina's CEO Francis deSouza joins us right now, first on CNBC. And Francis, thanks for coming in this morning.
Thanks for having me.
All right, there's a lot to dig through. Why don't we start with the numbers from last night? They were better than had been expected. What's happening in the core business right now?
Yeah, sure. We're really excited about the way the year is starting in terms of the launch of our flagship product, the NovaSeq X, which is our high-end next-generation sequencer. It's the most powerful sequencer in the market. We announced it in the fall and started shipping it in Q1. And a couple of things played out in Q1 for us. One, there's been really strong customer demand for the sequencers, and we're seeing that demand from high-end research institutions. But also, interestingly, 40% of the demand is coming from the clinical customer base, and that's usually a customer base that takes a little while to absorb new technology. But there's really strong demand from medical device companies that are doing diagnostic testing services, that are doing cancer therapy selection services, and also a lot of new to sequencing customers. So on the one hand, we're seeing really strong demand. We exited Q1 with 200 orders, which is the strongest book of demand we've had for any sequencer we've ever launched. And on the other hand, we've seen our manufacturing ramp really nicely. We were expecting to ship between 40 and 50 units in Q1. We ended up shipping 67. So really, our operations have done really well.
How much do these things cost?
Retail is about $1.2 million.
So better than expected demands in places that you didn't plan on seeing it. You're also talking about cost savings, reducing expenses by $100 million a year or annually on that run rate. What do you do to get that?
Yeah, so our focus now is that now that we've shipped the sequencer, we're looking at increasing our operating margins. Historically, we've operated in the range of 25 to 30% in terms of our operating margins. And this year we're at 22 because we did a lot of investment to bring out the new product. And so what we're committing to is bringing us back to 25% operating margin next year and then 27% the year after. So we've laid out a plan that looks at expenses across a number of dimensions. One is, we have a global footprint, and we're going to take advantage of activities in lower cost locations. We're rationalizing our real estate portfolio. We're doing some IT optimization. So there's a set of activities we've embarked on to drive the operating margins back into the historical range.
If you're looking at this chart, over the 1 year, stock's down 27%. That's in large part because of all these questions about the Grail acquisition that regulators in the UK or in Europe, in the European Commission and here in the United States have said don't do. The FTC has specifically said you got to unwind this whole thing. That's created a lot of questions. That's why Carl Icahn has gotten into the mix. Where do things stand with that right now? He thinks that you'd be better off without this and that he can get rid of Grail faster than you guys can.
Yeah, so let's start with what Grail is. What Grail is a blood test that initially we developed at Illumina that you can do, and it's a doctor-ordered test, and it tells a person if they have one of 50 type of cancers, from early stage to late stage. It's a huge breakthrough test. It's been in the market for about 18 months now, and the customer demand has been really strong. So
I've heard of this before, but this one really works.
This one does. And so the first 12-month revenue ramp for Grail has been the fastest of any cancer screening test in history. And what we announced in Q1 was that the demand continues to be strong. So we saw 100% growth in terms of the revenue associated with Grail from Q1 of last year to this year. There were 20,000 tests delivered in Q1. Now, we spun it out so that we could do the clinical studies to bring the test to the market, and then we reacquired it. And the reason we think it makes sense at Illumina is that we can accelerate bringing this test to more people more quickly, more affordably than Grail could do on their own. On their own, they're offering this test as a self-pay test. It's about $950, and they're planning to roll it out only in the US and the UK by 2030. In Illumina, we can expand the footprint of that test. We operate in 150 plus countries around the world, and we have teams that are experts in bringing reimbursement for tests. And so what we can do is make this test more available to people who can't afford the $950 test and roll it out more quickly.
That makes sense, but the regulators have said no. I don't know what their reasoning is for it, but it does have a lot of people, including some Wall Street analysts, who anticipate that the most likely thing is this thing is going to be spun back off, that you're not going to be able to beat the regulators saying no?
So we're working, as you said, both in the U.S. and the U.K. In the U.S., actually, the FTC's administrative law judge ruled in favor of Illumina doing this deal and against the FTC. Now, the commissioners overruled that, and so we're now going to court, and the U.S. Fifth Circuit Court of Appeals granted us an expedited review. Right. So we're going to go to court. The only time this deal has ever been reviewed in court was at the FTC ALJ, and we won that case.
What's the timeline for that?
The timeline is end of this year, early next year. And so the two legal processes play out in that same time frame. The U.S. Fifth Circuit Court of Appeals decision is expected in that time frame. Similarly, in Europe, we have a jurisdiction decision, an appeal, that's also going to play out.
What costs you if you lose?
In parallel, though, we're running a divestiture path. So we're moving in divestiture as fast as we can. And so what's happening is the divestiture path isn't being slowed down. So there's not really a differential between us keeping the appeals going or not. Right. We're still moving as quickly as we can, on the divestiture path.